Okay, hello everyone. Welcome to this week's weekly study session. I'm going to take a look at the market here, the key components of market health first. Major indexes are positive, new highs, new lows, up, down, volume, all positive. Individual stock participation we still have as neutral. We've seen some names are still working. As I pointed out recently, I think we're starting to roll into some of the laggards. The leaders have gotten extended. I'll talk about that more in just a minute. But one of the things I'm looking at here is the sentiment. We've come a good distance since we started this new uptrend or new bull market, if you will. Bottomed, of course, late 2022, started rallying in early 2023. We did have a pullback briefly, again, before we started rallying again into new highs here. But you'll notice that we had that period of time where we were rallying and we were staying pretty bullish on the sentiment as measured by, this is the Holbert newsletter digest, NASDAQ sentiment. And if you remember, I talked about how that persistent bullishness was something that we wanted to use strength for selling into. And then we got that correction and that pullback in the market. And we're in the same situation where now we've rallied, we've come a good distance here in the market, and a lot of stocks have gotten extended. And you can see we've stayed once again persistently bullish with the sentiment. And now we've actually accelerated into some of the highest readings we've seen in a long, probably the highest reading we've seen in a very long time. I don't think it's the highest reading going all the way back as far as this poll goes, but it's certainly very close to it and the highest that we've seen in quite some time. I think going all the way back to 1990. Or maybe that was another study I saw, but I'm pretty sure this is the one. I don't have that length of time here, of course, but you can see we did go into new highs here. We're almost up at the 100 reading, meaning 100% polled. We're bullish, 95.31%. And simply, this just means that, and this is just one sentiment poll, but as you're looking at the various sentiment readings, we're definitely in the very optimistic zone, and this is persisting for a while here. And it means that if we were to accelerate from here, certainly to the upside from here, I would absolutely use strength for selling. You take a look here, that those two little lines there at the bottom are showing the number of consecutive days that we've had excessive optimism. And the one that led to that pullback that we saw this last year, you can see this is actually a longer period of time that we're remaining in that optimistic or excessively optimistic zone. So, we're pushing the envelope a bit here. Of course, we did pick up in volatility when we had that pullback. Right here's that pullback, right between July-ish going into that October, November period. We had that volatility pickup. If you remember, I talked about how having that low volatility for an excessive period of time would usually lead to approximately a doubling in volatility, and that came very close to that. And that's what put in the bottom, of course. Now, when we take a look at the VIX and looking at that 100% rise, and again, we did come close. So even this looking at how long it's been since we doubled in volatility, it was pretty close. We might be able to check that box off. I think it's tied for the fifth longest since we've doubled in volatility. But if you take a look since we've gone up 150%, which would suggest a larger pullback, we're tied with the second longest since 1990. So again, it's gone a long time since we had that 150% rise in volatility. Now, that doesn't mean it can't go longer. It just simply means that we're certainly historically at the longer end. We've been up 15 out of 16. I think it's 16 out of 17 now. This was from last week, of course. Weeks that we've been up in the S&P 500. Again, this is another sign of that we're long in the tooth here for maybe a pullback of some sort, or maybe a rotation, of course, which we're already starting to see. The data says that usually within a couple weeks after you're up 13 out of 14, 14 out of 15 weeks or so, you get some type of pullback. So again, now looking at the number of days before we've had a 5, 10, or 20% correction, that's not as compelling or ominous, I should say. So there is some hope here that, we're not looking at any kind of major correction. We did have a good sized correction. Of course, the bear market correction, and that was after a long period of time. You can see down here, we went a pretty long period of time, about the second longest since going all the way back to the 1920s. And then we had the bear market, which certainly it was due. Now, volatility, we've got a lot of room before we get up to levels that we would be concerned that the volatility is signaling a bear market. And that's the thing with volatility. You want some volatility when you get those pullbacks, and that will lead to a low. But if you get excessive volatility, especially if it persists, you're looking at a potential bear market warning or a bear market situation. And I don't think that's in the cards. I don't think we're entering a bear market. Pullbacks are probably going to be viable. But the one thing that is concerning me, if you take a look at the top 10 stocks by size and market cap versus the whole market, this is a chart from Kenneth French from Deutsche Bank. We're looking at the only 2 times that we've been this concentrated. And, I've been pointing this out for a while with the top 20 names accounting for about 42 or 44% of the S&P 500. The top 5 names account for, I think it was 25% of the S&P 500. Out of 500 names, you've got 5 names that account for a quarter of the entire index. It's super, super concentrated. And again, you see, prior to the 29 situation, or you go into the 1930s depressionary era, and then the big bear market going into the 2001, and now we're up at those levels. And I wouldn't be as concerned to say this is necessary a bear market warning, but it certainly is a warning that we're heavily concentrated. We may have to rotate and diversify or broaden a bit, and that would be actually healthy, and that could happen maybe prior to a bear market. At some point, we're going to get a bear market, but up until then, I'm still, still somewhat. I'm certainly positive as long as our trend model is positive, as long as we're seeing stocks act well and behaving. So, but I would keep, always keep this in the back of your mind. And that's why I think selling at the strength, especially when you see a lot of bullish sentiment, makes sense here. These charts actually have not been updated. So I just want to point that out, but they're pretty much the same. The percentage above the 50-day and the 200-day. And this, again, just underlines that lack of participation and that concentration. Now, we are seeing some pin action, if you will, or some constructive action coming from the Russell 2000. Again, it looks like it's just potentially the beginning of maybe an uptrend here that could be starting to Russell. I actually bought the IWM, so bought some Russell, the Russell 2000 index. This is one of my ways of maybe diversifying and taking advantage of maybe that rotation before we get specific stocks. Still going to be digging in a lot deeper here to look for those specific small and mid cap stocks. Mid cap, the MDY also took a position in that. This actually looks better than the Russell, obviously coming out of a really very well-formed base and looking super constructive here. It's still early though, this is just starting to emerge. So I would start to look for stocks, in the small and mid cap area. We're still on that orange as far as the stem reading is concerned. And I think, like even when I took a look at the focus list last week, there was a bunch of stocks that tried to break out, and then they had volatility and they pulled back in and reversed, and there was some pivot failures. It's really a combination. There's a handful that are working out, but I definitely seen a shift in character for the worse. Not to the point where we're going to say it's hard penny and we need to really get defensive here, but certainly I would be much more selective and much more careful. Now, you take a look at something like the IBD 85 index. This coincides perfectly with where we started getting traction and seeing a really good period. I mean, we definitely had a really good run so far here since we've seen the relative strength pick up in the IBD 85 and the IBD 50. And again, you see, we're very early in a new uptrend. If we're really starting something that's sustainable here, this is just the beginning. And it could also mean where, the dogs are barking, and this is, before we get a pullback. That happens too. And when the laggards start to work and the leaders don't lead anymore, that's where you got to start being careful. Now, we've been overbought for a long period of time. You look at the short-term overbought readings. We keep getting to that overbought with very brief oversold levels. What that means, two things. One, that's really good long term. It means there's a lot of strength in the market. But two, it means that after you see this for an extended period of time, you're usually going to go to a period where you get overbought and stay overbought a little bit longer, and there's a change in character. And I think that's where, we've really got to start preparing for that, or being ready for that, for the other side of the trade. Longer term, the 25 and the 33 models are solidly bullish. It's going to take a bit of pullback in the SPY for these to go on, even to get neutral, let alone on a sell signal. So I wouldn't get concerned about that just yet. But and of course, these are very long term in nature. We've talked about, of course, the cycle work and how it gets bullish as we get into the mid of the year. Some have pointed out a comparison of the current situation to the period where we had the end of World War II, and we had an inflationary surge that was quote unquote transitory. It also coincides with, if you looked at M2, if you look at money supply, had a similar look of where it spiked briefly and then peaked and then rolled over and turned deflationary, and the inflation came back down. Now, in that period, if we look at that period, look at the market. This is actually looking at the Dow. You take a look at the market. And looking forward here, it looks very similar to what we could be experiencing if the seasonality and the presidential cycle plays out. And that would also be bolstered or fueled by a decrease in interest rates, because around that first cut in a non-recessionary environment, if we don't see a recession and we get interest rate cuts, it's a very strong tendency. So this is where we could see a continuation of the bull market. Maybe the leaders keep leading and that leads to a top, or we get that rotation and we start seeing a broadening of the market. Either way, you want to just pay attention to what the stocks are telling you and participate in whatever areas the money's flowing to. But certainly we've got a potentially still very bullish picture going forward. Now, balance this with the fact that, here's the kind of the rub, or the, if you want to say it's different this time, the only thing that I've seen that's different, and again, time will tell whether this is leading to a recession, but the index of leading economic indicators, the LEI, has been in a downtrend for a pretty extended period of time. And every other time it's led to, as you can see, those shaded areas, those are recessions. If it's led to recessions, and we have not had a recession, but when you go this time around, when you look around the world, and I pointed this out last week, we've actually seen recessions in the United Kingdom, in other parts of the world, in Asia and in Austria, and the markets they've handled it quite well. So this says a couple things. One, maybe we get a recession, but it's not so pronounced, and the market handles it as well as some of these other markets. Or we don't get any recession, we get a soft landing, and then we get those rate cuts without a recession, and that's where that very bullish environment can unfold, maybe in the next several months, but certainly in the second half to first half of next year, second half of this year, first half of next year. And again, I'm going to show you also, we made a few additions to the platform, which I'll show you in just a second. Long term, still bullish. We need to be bullish because stocks are still working on balance and our models are bullish. I would be on the lookout for two things. One, volatility. on a stock by stock basis, and then of course in the overall market, and rotation. Look for rotation now. This is where you want to really start to see where that money's rotating and move with it. Leaders could run more, but if they really should start to accelerate from here, you're definitely getting climactic into a market that already has a lot of bullish sentiment. That is definitely a time to sell. And a lot of people find it very hard to sell at that time, but that's where you've got to have the courage and realize that you might not be getting the high. It may go even higher, but you want to get out when the getting's good before and not give the stocks a chance to break. Because once they do, they come back so fast and so hard that usually you get a worse price than if you sold even lower into strength. So that's just a tip from a lot of experience. Extend it from here, like I said, is a big sell. If you're running up from here and you're getting really extended after you've already been extended and you've already got optimism, I think that's a big sell signal. New breakouts, yes, but more selectively, more carefully. Stops, keep the stops tight. Move your stop, improve your stop more quickly. Position size maybe more conservatively. Take smaller profits. Everything. Bring your parameters in and prepare for a little bit less little bit less fun in the sun than we've seen. Now, real quick, if you go to the screens, and again, we're in beta testing, and this whole look and everything is going to get much nicer. We're launching a whole new, revamped, a completely new look that's really slick and just beautiful. It's still going to take its months away for that to be launched, though. And so we're just putting the changes in the beta form here, but we've made a couple of changes here that are pretty neat and interesting, and certainly make things life easier. One is where you can now on your screens you can right click and you can go and add them to any list that you create will pop up when you right click, and then you can simply say add to and it'll add to that list. You can also, which I really like, is you can hit the left arrow key and the list will come up. So as you're scrolling down, you can hit the up and down key or just hit down, down, down. It'll flip through the charts. Then when you see one you like, you hit the left arrow key. This will come up. You scroll down to with the down arrow key for which list you want and hit enter, and it will add it. And then you just once again hit the down arrow key and go to the next stock. So you can very quickly, you don't one hand doesn't have to even leave the arrows and the enter key, and you can just scroll down, see something you like, add it, scroll down, and really very quickly search and add. Oh, actually, I was supposed to zoom up on that. Sorry about that. So yeah, so this is what'll show up. And again, when you add your list here, they will automatically add here. Now, I think you can do it from the other areas too, but if not, we're going to add that where you can move things around and add them to a list from the focus list or things like that. But right now, I know it's definitely enabled from all the screens. Okay, another thing is too, and I don't have it here to show, but when you have on the focus list, when you have something new that's been added, so it's Tuesday and we just added 3 new stocks today, it will show up in the comments as new. So, and you can sort it into new, or I think they'll just cascade to the bottom too. So you'll see what's new added over here if you just want to scroll through those. Also, we've added what's called the Minervini buy risk indicator, if you will, or gauge. And there's two ways. There's the buy risk, there's the line, the regular one, and then there's the colors. Where the colors just color code it. And we have it color coded where it's neutral, it's bullish, neutral, or bearish, red, of course. Or you can actually see the line, and that's the number. There's 12 components of it, 12 particular measurements technically, and you can see where they are. But the bottom line is that, and with the pressure, you definitely want to concentrate on your buys when they're both green. If you're coming from a low cheat or even a cheat, you might have where the pressure has not come off pressure yet, but usually does the day it breaks out or the day after. And you might also be on yellow. You might be on neutral, but red, you want to stay away from red. If you're on red on the buy risk, there's almost no time that I'm going to be looking to buy the stock. And this is based on what Mark Minervini is looking for. That's really what this is. That's why it's called the Minervini buy risk, because to me, it's a, any, if it's not green, then it's a risky buy to get stopped out. So we spent a lot of time coding this, and it's pretty damn good. I got to tell you, especially if you're new and you're wondering if I should be buying here. Now, it doesn't mean the stock might be set up, might be setting up, but it's just not ready for where you get that right side tightness, or ready to where it's just meeting the criteria to allow for that. So you just might want to wait a little longer before you pull the trigger and looking for that pivot point. Now, if you're developing a pivot, it's tight, it's in the base, it's almost certainly going to be green 95%, 98% of the time. So that's just a quicker, way to be able to. So now you've got the RPR, which is our version of the relative strength, and you can see, how that's performing. You've got the pressure, which is the real very short-term immediate trend, and then you've got the buy risk, which is a bunch of measurements that are going to tell you, if the stock's meeting the criteria to be buyable or not. And then, of course, whether it's in a stage two uptrend, there'll be some overlap with the buy risk, which will, if you're in a stage two downtrend, a stage four downtrend, it would most likely be red. But it could turn green, even though you're, maybe not in a complete stage two uptrend, but you'd want to be in a stage two uptrend as well. So anyway, that's what we have new, doing a lot more. We've also been working very hard on the new grading tool, and hopefully we're going to be able to release that in the very not so distant future here, within weeks, no more than definitely a month or two. So we're working on that. And that's it. I'm going to leave you with one of my favorite places. This little boathouse is where I wrote. For those of you who don't know, I wrote my first book. Almost my whole book was written in that little boathouse right there. I used to go every day and work on my book. It was just an amazing, quiet, peaceful place that wasn't too far from my home. Anyway, we'll see you tomorrow at 11:30 a.m. with myself, Bob Weissman, and Mark Ritchie, of course, to answer your questions and live Q&A. Have a good rest of the night, which is what's left over here on 6:15. I'm going to do some stock work and watch NASCAR racing in the background. All right. I'll see you guys tomorrow. Bye-bye.